I'm very pleased to be joined today by Ben Crowne and Jessie King from Quantuma's Forensic Accounting and Investigations team. Ben is a director of the team, having joined from EY as one of the first members of the team back in 2018. His specialisms include commercial damages, non-contentious valuations, and the application of accounting standards. Jessie is a manager in the same team. She assists with the provision of forensic accounting advice in a wide range of disputes, specialising in contentious valuations. In addition to client engagements, Jessie also regularly presents workshops to lawyers on matters related to forensic accounting and accounting more generally, in addition to disputes and business valuations. Today's session is going to cover quite a number of aspects, which will include the different types of valuations and why they're required, what happens when a seemingly straightforward valuation assignment turns hostile, the process for determining a valuation beyond assets on a balance sheet, valuing startups or growing businesses and the importance of a robust forecast, and ensuring a valuation stands up to scrutiny. Before we get started, I have got a few pieces of housekeeping that I just need to run through. So just a quick reminder, Q&A functionality is still on. We ran through this session earlier in the week just to kind of get a feel for how long it's going to take us to get through. We believe that we've got a fairly full session and it should take us right the way through to about 10:30 today. We're going to try and get through as sort of in time to get you all the way on time. If you have got questions, please do feel free to drop us a note through the Q&A. I will pick those up and we'll drop them in where we can do. Again, same caveat as earlier on, if we're not able to get through all of the questions, we will be passing them through to Ben and Jessie later on, and they will come back to you individually. Today's session, so one of the things that I need to just draw to your attention, it's pretty detailed in terms of the content, but it does come with the caveat that valuation is not an exact science and can often be highly specific to the case. So not everything that's said today will necessarily be relevant and or appropriate in all contexts. Again, as I've just said with Jeremy, we are going to circulate a document following today's session, which will cover the specifics of today's masterclass, and it will include some additional details. So we'll get that out to you as soon as we can do. And finally, we are recording today's session, as you will have seen, and a copy of this will be available on demand on the K3 Hub website and the Quantuma website in the coming days. Right, we're going to run this in Q&A. So without further ado, I'm going to get into this now. So my first question is to Ben. So Ben, can you tell us why valuations are required and what type of valuations are there?
Morning, Maria, and thanks everyone. It's good to be here. Broadly speaking, the purpose of valuation, very straightforwardly, is to understand the value of an asset. That could be a particular physical object. It could be an intangible item like goodwill, like the intellectual property of a business. It could be an entire business, a business stream, a group of businesses. Something essentially that is definable, and for whatever reason, a value needs to be put on it for some form of legal process, whether that's a purchase or sale, whether that's litigation, and so forth. Like I said, valuation exercises can focus on any part of a business, from a particular stream of project that may happen in the future, all the way up to sort of a business as a whole. And then once you've defined what that is, we either look at the value of the entity as a whole, whatever we're looking at, or we might look at the value of a specific ownership stake, a specific shareholding, even a value per share or something like that, if it's something that might be later sold on the open market. So really, the primarily professionally what we'll deal with is business valuations and shareholdings thereof, but the range of things that can come across over the course of a year is sort of, covers everything I've talked about.
Fantastic, thank you. Jessie, one for you here. So what kind of scenarios might require evaluation?
So it's, again, the types of valuation. The scenarios is also quite broad. So kind of starting off with non-contentious valuations. So that's quite a peaceful exercise. It could be required for financial reporting purposes. If you're needing to incorporate the value of an intangible asset within your financial statements, there is a growing trend for understanding the value of the intangible. Similarly, you might be wanting to value shares for tax purposes, for creating a EMI scheme. Then moving on, valuations commonly, usually required in negotiations surrounding buying and selling either a business as a whole or individual shares. And then moving on to the contentious aspect of business valuation, and that is involved or incorporated into dispute resolution and litigation, and commonly includes shareholder disputes, matrimonial disputes, CPOs, so compulsory purchase orders, loss of profit claims, and termination of commercial agencies. All of those are where the parties involved need to understand the value of the asset or business which they are kind of considering. And
Great, thank you. Jessie, I'm going to stay with you for the next one. So can a non-contentious matter turn into a contentious matter? And if so, can you talk us through a range of examples?
Yeah, so everyone always has the kind of best of intentions when they're going into an exercise surrounding business valuation. Even in a contentious matter, people want to do it in the kind of calmest and most friendly manner. But the best of intentions can always fall away. And an exercise that starts as non-contentious can easily escalate. Looking at the kind of commonly non-contentious valuations, so share scheme valuations, if HMRC decide to challenge the valuation, that can escalate it, and the valuation needs to be proven to be robust more than it might have initially intended to be. Even in the context of dispute resolutions, it can valuation exercise can range from being more amicable to being quite highly hostile. And the important thing to bear in mind at the beginning of any valuation process is to anticipate any risk, so that you can kind of create or prepare your valuation in the manner that is going to be most suited for its eventual purpose. So even if you're doing a kind of less contentious valuation exercise, you might be doing it in a more informal manner. If there is a risk that it's going to turn more contentious and will be challenged, you need to bear that in mind and make sure that the valuation can still be used later down the line. And there is always an inherent risk for challenge, as valuations are subjective. As Marie mentioned at the beginning, it is an art, not a science. And the valuation commonly presents a position at one point in time, and there are always, or businesses are always moving. So that's another issue that needs to be kind of kept in the forefront when looking at business valuations.
Great, thank you. Ben, coming back to you for a second. So what type of valuations work do you undertake, and for whom?
Sure. So like I said before, primarily what we'll see in the average month is a business valuation case of the whole company, where we've been instructed by the solicitors or once in a while by the business or shareholders directly. That's most in the context of a dispute of some kind, a contentious valuation, court proceedings, something more specialized like matrimonial, but also we do act sometimes as expert determiners, either through the presence scheme at the Institute of Chartered Accountants or in other contexts. And there we sort of get submissions from both sides. We go back, we ask questions, and we then provide a single valuation which takes into account everything that's been provided. Sometimes it's speaking, we say what the value is, we say why, we give reasons. Sometimes it's non-speaking, there's just a piece of paper that says, based on everything we've been told, here is the number at the end. It's an increasingly popular ADR resource for sort of mid-sized claims of the high hundreds of thousands to mid-millions, where it's not necessarily worthwhile, or in terms of risk and costs going all the way to court, but where you want to make sure that there is sort of a rigorous process with someone independent involved. So it's really a mix. Like I said, sometimes we act for in matrimonial context. I personally do a bunch of work for CPOs in the context of especially major infrastructure schemes, and then more elaborate things that come in once in a while, tax planning, sometimes valuations for IP, for transfers across borders, that sort of thing.
Great, thanks. And Ben, just sticking with you for a second. Are there trends or what we might consider peaks and troughs in the valuations market? And if so, what drives them?
I guess anecdotally, I can say certainly a change in tax regime concentrates people's minds. So we often see if a budget looks like it's going to target capital gains tax, you often see transfers or transactions of various kinds lined up in advance of that. It's often an incentive to settle or resolve a long-running dispute. There's a change in the legal atmosphere or legal precedents elsewhere. We may see a lot of flurry of specialized cases, for example, in a matrimonial context. Obviously, coming out of COVID, we've seen an uptick both in litigation and also various types of arbitration. I had something in my inbox this morning from the International Commercial Court, which is a major arbitration hub, who had their busiest year ever in 2020. I think we're seeing also that a lot of the entities and arbitrators have done better at this than the courts have, who'll be able to move online effectively and they'll be able to cut case times and be able to progress things. Have seen an uptick an uptick driven by the fact they run an efficient process. And that's not saying that the facts which underlie the dispute are any different, but there is sort of a nudge to resolve things in a certain way. I guess more generally, obviously, in the context of dispute, there is often an imbalance between the two parties, and depending on the economic climate, one party or the other may feel they have a benefit in pushing things forward. Right now, for example, in the start of the pandemic, we saw people might benefit from a lower valuation, pushing for a valuation. Let's have it happen at this point. I remember I was supposed to have a case the week of lockdown in the commercial courts, and we said, well, should we just take 6 months because no one knows what the world is going to look like. No one knows really how to value. No one really knows how to value this sort of software and tech company at this point in time, with the markets in so much fluctuation. The other side quite wanted a valuation then and there, and said, well, no, I think this all seems practical. We can just all stand a little bit further apart in court. We can stand separately in the security booths and so forth as we come in. And that was, I think, like the 10th or the 15th of March last year. And then sort of a week later, the thing just, the national lockdown sort of superseded it. But there was sort of a big push for people who felt they would be disadvantaged by having to wait 6 months to get stuff over the line. And like I said, similarly non-contentious work, which I do a bit of separately, things like employee share schemes and the timings of transactions around there often tied to anticipated peaks and troughs in valuation, anticipated changes in the legal environment and so forth. I guess I should also say that a proper disputes process, a longer term valuation process, can take months or years. And the point that where we get involved is not necessarily the point, as you'll appreciate, where things actually get started.
That's great. Thank you, Ben. I can see that we've had a couple of questions come in already. I think having a look at the nature of them, I think we are going to cover some of this later on. So what I'll do is I'll come back to those questions at the end of the session, if that's okay. So Jessie, just coming back to you for a second then. So can you talk us through the process of determining a valuation, please?
Yep. So starting at the beginning, assuming we're valuing the company as a whole, broadly speaking, as Ben mentioned earlier, a valuation seeks to place a financial value on the assets of the company, being the physical assets and the intangible and the trade. So this is comparatively straightforward when considering tangible assets, so the items that appear on a balance sheet. But it becomes more challenging, and it's the area where the expertise is really required when you're determining the value that may be applied to the trade of the business. Most businesses which are trading profitably will have a value above the value of their net assets, and that is commonly referred to as the goodwill of the business. And a valuation of the trade seeks to place a value on this on the trade by valuing the future income or profits that is expected to be generated from that trade. The approach that is taken in determining the valuation of the trade will depend on the information that is available and the stage of the business. So if the business is a startup or growing business, then the approach needs to be more forward-looking than if you're looking at an established business where the historical and the current trading performance of the business is quite an accurate representation of what may be expected going forward. So the physical process involves collating documentation and the information that is available, potentially creating information that's not available depending on the kind of importance of that information, determining the methodology, understanding the trade of the business, and benchmarking the company against its peers and competitors. The process isn't kind of straight line start to finish, and you may need to circle back to an earlier process as more information and becomes available and you get a deeper understanding of the business that you're looking at.
That's great, thank you. Right, we're going to move into some sort of slightly more technical areas and get into the process now. So Ben, Jessie's just covered off sort of the high level process that you would apply. So let's start off with the documentation then. What types of documentation do you require upon being instructed?
Yeah, I mean, we're kind of at the mercy of a business and the sort of things which it tends to perform. I think ideally, you know, the gold standard valuation is to have sort of robust and reliable records for the last 3 to 5 years, forecasts going forwards for a few years, and in a business where you can either, you know, where you can see the accuracy or not of forecasts against budgets. So a process whereby you not just see the past numbers and the future numbers, but also have a sense of how good that particular business is at making those forecasts and hitting to them. That's particularly important, of course, when you're doing something like valuing a startup or valuing a business which has sort of a range of newer or growing businesses where the historic performance is not necessarily going to line up with what you're going to anticipate going forwards. Things like management accounts, budgeting for a single year, those are the sort of, you know, bread and butter things which you would expect to see. Often statutory accounts don't have all the details, so things like detailed P&Ls, particular schedules for transactions which might not be done at a market rate, direct remuneration, that sort of thing. You know, I have a list sort of as long as my arm that we can send and tailor. But fundamentally, what we're trying to do is to understand, first of all, you know, what the business looked like, second of all, what the business will look like, and third of all, the extent to which there are parts of the business which are not being captured through the market rate transactions at a particular point. So we may, for example, if the business has been carrying, so an asset is at a historic price on its books, you know, a property or some sort of investment, we'll need to understand how that might differ to what's recorded in the accounts. A business may have, for example, potential liabilities or that are off book that are not necessarily fit the accounting criteria for recognition, but which we would want to see in the context of valuing the entity overall. And sometimes it's the other way around that we see quite often, for example, for property companies. There's a deferred tax provision for the full amount of tax that they'll have to pay on the gain on investment property. That's all very well from an accounting perspective. From a valuation perspective, you would ask, well, is that liability definitely going to occur? Is it likely to occur? When might it occur? In what circumstances? And you might very well apply some sort of adjustment to even something like a liability, which usually goes into the books at its actual value, in order to adjust for whether a buyer would consider that liability would actually become due or not. Once in a while, you'll want to see things like if you're borrowing under special terms, if there's an implicit underwritten guarantee from elsewhere in a group, there's all sorts of things which you might need to take into account in valuation. But I think the underlying rule is, and I think those professionals will appreciate, is that If something is clearly and rationally documented with a lot of supporting evidence, then usually it's reasonably straightforward to take that into account. The problems arise when everything is in the head of a director, things are very opaquely mentioned, things are just scrawled on a piece of paper or literally on the back of the envelope sometimes, and then you have to try and reconstruct everything that's implicit within that within that arrangement.
Brilliant, thank you. Right, let's move into the second part of the process that Jessie touched on. Let's have a look at some methodologies then. So I think we've got some slides to cover off the next few points, but just to get us into this, tell us a bit more about the different methodologies that you apply and what determines which one you would use. So Jessie, I think you were going to look at the cost base to begin with.
So the cost base tends to be the starting point at looking at the value of any business. And this is effectively trying to determine the value that a third party would pay to obtain an asset of equal utility. So that is usually looking at the net assets of the company. And broadly speaking, the value determined using this approach is seen to be the kind of minimum and the floor in the value that can be applied to the company. Obviously, if you're looking at a limited company, if you've got a position of net liabilities, so there is a negative value, that value is restricted to nil. So just looking through some of the kind of common adjustments that you're making. So you're not just going to take the net assets as they're presented in the accounts, as Ben was kind of hinting at earlier. You will be, adjustments are required to make sure assets and liabilities are recognised at their full market value and realisable value. So, for example, looking at this case, we've got intangible assets, which are goodwill, which, as I mentioned earlier, assuming that's the goodwill of the trade, that's the value that we're going to be looking at when we consider some of the other approaches. So if you're basically looking at the cost approach, it's common to remove this value. Looking at the tangible assets, if you've got assets that are held at their cost, that might not be representative of their market value. The kind of common example of that is property. If property was purchased a number of years ago, it may have been at a lower value than it is now currently worth. So you might need to increase value. Also, at the moment, we're seeing a lot of value of properties decreasing if they were, well, depending on when they were bought, and so that could be a negative adjustment. As Ben mentioned earlier as well, you look at not just the increase in the value of the property or the decrease, but also the impact that that might have on your tax liabilities. So at the bottom there, against provisions, we've got an adjustment, and that could be for the increase in deferred tax on that gain. And as Ben mentioned, we need to consider the likelihood of that gain or that liability being realised. So if it's a company that's anticipating selling the property in the foreseeable future, we might take a larger proportion of that liability in looking at the cost base value than if it was expected, the company was expected to hang on to the property for a number of years or had absolutely no intention to sell the property. Then looking down some of the other items, looking at recoverability of assets and debtors, you might need to adjust for that if there's debts that seem irrecoverable. And then we've got directors' loan there, and an adjustment against that. And it's quite common that directors' loans, so an overdrawn balance, so an amount that their directors owe back to the company, will in fact be cleared through the declaration of dividends if they are shareholders. So you need to consider how that's going to be cleared, and if it's a declaration of dividends, the director shareholders aren't actually going to be paying back the money into the company. It's going to be settled by a kind of dividend in specie, which isn't physically paid to the directors but just wipes off their directors' loan account. So that's again not a value that is going to be realizable on a cost-based approach. So Ben is going to, I think, take you through some of the kind of trade-based valuations.
Yes. So, well, shall I do A DCF, and you do the
Yep.
multiple approach. Yes. So fantastic. There we are. So what's called some accounting standards, the income approach, where you look at the future income that an entity will generate and you adjust that to a present value. Almost always we approach that what we call a discounted cash flow, a DCF. Don't worry, I'm not going to force anyone at 9:30 in the morning to wander through this model in detail, but essentially what you do is you construct a multi-year projection of what a business is going to trade at. It could be something relatively consistent, like this one. It could be a business that's growing rapidly. It could be a project that's going to go up and then come back down, some sort of and the primary issue is sort of the pipeline of sales and the timing of those. And you stack up all the sales, all the costs, all the other issues that might affect cash flow to come up with basically a single number for each year of what the free cash flow of the business is going to be. And then you apply a discount rate, which takes into account the fact, first of all, that we're talking about future money rather than money now. It takes into account the time value of money and takes into account the risk of the risk of the investment, the risk of investment over sort of a risk-free investment like government bond, the chance that the business will turn out differently, the forecast won't work out. I suppose I should say that there are a number of ways to model risk in that you can use. I maybe we'll come on to some other questions a little bit later. You can use a more sophisticated approach to forecasts as well, but generally in terms of presenting something that is sort of robust and reliable, but which also is sort of usable and adjustable and comparable to what another side in a court case might be doing to a judge and lawyers can meaningfully discuss. What you tend to do is we tend to construct forecast numbers for each year and then a discount rate which takes into account all the various risk and other factors. Multiply that across multiple years, the discount rate increases year on year as you get further away and things become more remote and more uncertain. Take an adjustment at the end for the what we call the terminal value of the value of the business, so at the end of the projection in 5 years' time or however long in the future, and then adjust that all down to what the present value is right now, apply adjustments for debt and so forth, and then go from there. And you can use this really for anything from, you can use it for a pharmaceutical product, you can use it for an expansion to a foreign country, you can use it for a football stadium. It's something which sort of can apply in any context, and it essentially relies on the accuracy, the perspective of viability of the forecast that it's based on. So in theory, it is the gold standard valuation. In theory, it is the way that you would go about valuing anything up to a global multinational company with value in billions, but it is quite a subjective process to the extent that information is not necessarily known for sure, to the extent that the information has to be gathered specifically for this. The discounting process it becomes more subjective with smaller and private companies, and in a contentious situation, something like a DCF will often be subject to challenge. You may have two DCFs which look similar. If the experts do their jobs properly, they'll liaise, they'll come up with a model which separates the inputs, but which is a single basis that the courts, the parties, and so forth can use if they're able to work constructively together, and they can come up with very different numbers. I think the last time I did a DCF in a litigation context, we came in about 150 million. The other side came in at 500 million. And when we got to court, so at the end of cross-examination, we asked the judge, would you like us to talk through the underlying assumptions that underpin the differences between the two DCFs? And he sort of shrugged and said, well, if you'd like to, then that would be useful. So there is an extent to which even if we try and drill down to something which is comprehensible and has as few variables as possible, ultimately it is judgmental and tied into really the story of how the business is going to perform, the commercial prospect is going to perform going forwards.
That's great, thanks, Ben. Just before we move on to the final methodology that you're going to talk through, there has been one question. I think it's probably worthwhile covering it off now. So, Ben, question in from John here. The question reads: can Ben give any guidance on how to choose the appropriate discount factor for a DCF basis?
Yes, well, that's really the question, isn't it? So I'll just do this very quickly. So obviously there are technical bases, there are technical models for constructing a discount rate, or weighted average cost of capital, CAPM, and the build-up method and so forth, that the accountants here will remember from their ACA, or you may remember from sort of a business or valuations course at university or business school. So there's that side of things. There are market comparables, especially if you're looking at slightly larger companies. Duff and Phelps, Kroll, I guess these days, have a cost of capital database. Aswath Damodaran, who's a very well-respected valuations expert who teaches at NYU, has a website with discount rates based on industry, discount rates based on country, different inputs and risks. So there are a range of resources that are available. And then there's a sense of needing to sense check that against what, against, how to put this, there's need to sense check this against the number that comes out at the end. That, if you put in a discount rate and you come out with a number that looks different, significantly different to what you'd expect if you value a company on a different basis, on a multiple basis, on a cost approach, then you probably need to go back and check that things have been done appropriately. Sometimes you'll see, for example, you'll have, and I think we see this increasingly in a private equity context, in the context of people who are valuing a business now, in the context of what they think the value is going to be in the future, that there's an implicit discount rate. You can take a forecast that says this business is going to be 5 times bigger in 5 years' time. If you take what the projections are and you backdate that to what the value is now, you'll often get an implicit discount rate of various kinds. I will just say one more thing. I don't want to keep. I see there are a few questions on this at the moment. We'll circulate a note afterwards with a few useful resources. Some of them are free, some of them are subscription based. I will say one more thing, which is that if you, and I apologise, this is slightly technical for first thing in the morning, but if you think of what a very, very simple discount rate, very, very simple DCF is, if you say you don't worry about fluctuations over time, you don't worry about sort of the forecast will change, you just say, well, I've got a number and this is going to be the same number every year going forwards. I'm going to discount rate to this particular rate. It's going to go on forever. So sort of a conceptually, something which is definitely a DCF, but which is as conceptually as simple as possible. What you've essentially created is a perpetual annuity, and you'll value that on the basis of the reciprocal of discount rate. If you apply a discount rate of 10, that's basically a multiple of a discount rate of 10% is essentially a multiple of 10x. So in very, very broad terms, a discount rate for a business which is stable and which is expected to go on indefinitely will look something like the inverse of the multiple for that business. But that's obviously a very general rule of thumb. It won't necessarily apply if a business is growing, if the business is is not expected to last for a very long time. But once in a while, I've got a report on my desk right now where the reasonably well established and I respect the expert saying, well, I've created a multiple of 6x via this, and I infer therefore that the appropriate discount rate is of the range 15 to 20%. And you sort of bite your lip and you'll say, well, maybe, but certainly that's a decent place to start thinking about these sorts of things.
That's great.
Yes, I think there's more questions. Maybe we'll have time to do a couple of them later.
Yeah, I think Karen has asked here about the names of the resources for discount factors. I think we'll include those in the document that will circulate following this session, if that's okay. Great. Okay, Jessie, back to you then, just for the final methodology.
Yep. So as Ben was saying, the DCF approach is the kind of gold standard. approach for valuing businesses, but it relies on having robust forecasts, which is commonly not the case. And in the absence of forecasts which we can rely on, we would look at a market approach. So market approach is a valuation based on comparing the company to the value achieved on the sale of a similar asset or companies. And so market approaches can be kind of looking at any level of profits of the company, the most common being an EBITDA approach, which is regularly seen in M&A transactions, but you can have a multiple of sales. So if you're looking at a professional services company, that might be valued on a multiple of sales. But carrying on with the EBITDA approach, so that's earnings before interest, tax, depreciation and amortization. And commonly at the moment is also, it's extended to be EBITDAC, which is also before COVID. So the first step is to determine a level of maintainable EBITDA. So we've got a very basic calculation here, just looking at the common adjustments which you would expect to make. So we've got the depreciation and amortization being added back, bad debts or other exceptional one-off costs, which while incurred historically, you're trying to work out what isn't expected to be incurred going forward. So we're trying to get a level of adjusted EBITDA that we think the business is able to maintain going forwards. And so the kind of next common adjustment is in respect of directors' costs. Regularly owner-managed businesses, the directors won't necessarily be taking a market rate of remuneration. And so we need to kind of understand the actual market cost of those directors for the roles performed. There could be multiple directors, but actually the business only needs one. There could be members of the director's family on the payroll, which isn't akin to a market rate cost. Directors, yeah, they might be taking a dividend, and I've kind of recently seen where an expert kind of explained not making a market rate directors cost adjustment on the basis that the director was taking dividends, and so that was akin to his remuneration. But the approach, or the whole purpose of this exercise, is to try and understand the profitability of the business going forward if it was run kind of by an independent third party. So regardless of the fact that the director was receiving remuneration, that wasn't being reflected in the profits of the company, and so we still need to make an adjustment. Then again, we've got profits on disposal of fixed assets, so that's again looking at the kind of exceptional items, and then a market rate rent adjustment, which I've included there. So that's commonly required if the business owns the property from which it operates. So we'll look further down in the calculation at the approach to the property, but businesses commonly don't need to own the property from which they operate. They can lease it. So the approach here is taking, well, what if the company sold the property and leased it? What annual rental expense would it incur going forwards? And for that adjustment, you'd commonly need, in a contentious matter, a surveyor to opine on the market rate rent and the market value of the property. So once you've concluded on your maintainable EBITDA, so if we look there, we've got a range. It's quite a consistent range with the exception of 2020, and it's most common that COVID years are probably going to be excluded if we, assuming the business was heavily impacted either negatively or positively. It's probably not going to be an accurate representation of the future earnings potential of the business, but that is not a definite. So once you've determined your maintainable EBITDA, we'd try and work out a multiple, and this is the element that is based on the comparative information. So competitors, listed companies, published indices, kind of collate all of that information. And it also brings in the aspect of judgment and the expertise of the valuer, which takes you down to your enterprise value, which is the value of the trade. And then we've got a few adjustments below that. So that's to get you to the equity value, which is the value that is attributable to the shareholders of the company. So I mentioned earlier, businesses don't need to own the property, so you sell and lease it back. so you'd add back the market value of the property, you take off any loans which would have to be repaid, and then at the bottom there we've got a working capital surplus and deficit adjustment. So that's looking at the extent to which the balance sheet of the company has assets in excess or insufficient to maintain the working capital requirements of the business. Kind of final point in valuation methodologies, you would also commonly look at recent transactions in the shares in that company. So if the companies or an individual has sold their shares in the company recently, have a look at what value was achieved on that, and also the extent to which the company is paying dividends and the kind of dividend-based approach, but that's commonly only applicable where regular dividends are being paid and where you're looking at a minority shareholder interest.
That's great. Thanks, Jessie. I'm going to stick with you for the next question if I can. So are there any specific principles or standards?
So there's terminology. Terminology is partially defined in places. So you've got the market value, which is effectively an arm's length transaction with a willing buyer and a willing seller who are both acting knowledgeably. Then there is the equitable value, which is the value that might be applied to a business or a shareholding between known parties who have particular interests. So if we're looking at a minority interest in a company, if an individual has a 49% interest and someone is looking to sell their 2% interest, they may pay above and beyond the market value of that interest, that 2% interest, because it would give them a 51% interest and would give them more kind of control over the decisions of the company. Another kind of term that is commonly used is fair value, and fair value can be defined differently depending on the context. It's a term that's commonly used in accounting standards, but it probably needs to be kind of more stringently defined if you're trying to instruct someone to undertake a valuation of a company, because it's got a broader interpretation. In looking at kind of principles and standards, there is the International Valuation Standards Council, which prescribes which kind of defines the approaches, and that's defines the different methods that Ben and I discussed earlier. You'd also kind of commonly need to look at any shareholders agreements and articles of association for the company, because that might dictate how a company should be valued or how individual shareholdings, whether minority discounts are applicable or not. And then I'll also just add that kind of depending on the purpose, specifically at the moment, family courts are kind of concerned with fair results, and there's been judgments recently where the judge has kind of adopted an approach which kind of expands on or adapts the expert valuer's approach to give a fair result, but that's kind of taken into account all of the wider circumstances of the matter.
Great, thanks, Jessie. Right, we're into our final few questions, and I can see we've got quite a large number of questions coming in. So, Ben, back to you then. So we're going to talk about outcomes now. So, Ben, what type of outcomes can we expect from evaluation?
Oh, sure. I will just very quickly supplement what Jessie just said, just to flag for those who are interested that just this month, a new sort of consolidated glossary of valuation terms sort of been jointly published by a number of leading entities, the American Society of Appraisers, RICS, the Chartered Surveyors in the UK, the Saudi Authority of Valuers, Chartered Business Valuers Institute. You'll find it on all their websites. It sort of tries to create a common glossary of various terms of various bases. What they say for fair value, and I did smile when Jess was talking about it. Fair value is a standard value for which there are different definitions depending on the context and purpose. So, thanks very much, guys. What kind of outcomes do you expect? So I know, from long experience what people want at the end of the valuation is a number, that there is a business, there is a product, whatever, it is worth a certain amount. That is a definitive number. It is robust. It will not change. There is no ambiguity. Maybe you've rounded to the near a significant number, but that's about it. Now, of course, in reality, a lot of the time, things are less definitive than that. Often when we're preparing a valuation, usually what we are doing is constructing a range of values. We're constructing a range for what the future earnings are, what the multiple might be, what the discount rate might be, and so forth. And we are applying at a certain amount of a certain, well, I guess what a statistician called noise, a certain amount of natural variation is built in to each of those numbers. You combine them all together, you get a number which also has a certain amount of variation. So often what we will communicate is we will say we believe value is in this range, and our sense is it is towards the high end of the range, the low end of the range, and we will provisionally say this number. But so especially if you're getting a valuation that has decimal points, 3 significant figures, there has to be recognition that that number is not the accuracy is somewhat illusory. No one's going to say that this is because you have 3 significant figures here, this value is accurate plus or minus 1% in all circumstances. And depending on obviously the context, if it's contentious, you may be, the range can be more valuable than the individual number, because that's what will give for the lawyers, the business, the client, a sense of how much of how to proceed. If the experts between them have overlapping ranges or are in sort of the same ballpark, then that sort of informs you quite differently to where the numbers are 4 or 5 times sort of apart. Often, like I think I mentioned before, sometimes you're in a context where all you'll get is a piece of paper with a single number. If you are in that sort of context and there's not that much that you can go beyond, so if you are instructing people and you want to get, and for cost reasons or for process reasons, you don't want a full report, you don't want the full reasons, nevertheless, it's often valuable to say, well, we'd like a number, but we'd also like the 2 or 3 key assumptions to give us a range from there.
Great, thanks, Ben. And just a fairly simple one, just to sort of round off that part of the outcomes session. How is the outcome delivered?
So sometimes, like I said, it's just a letter or a note. Sometimes, especially if we're working out in a non-contentious process, it is a formal report with a signature at the end that is then just going to go off to a third party. In a court proceeding, it is again an expert witness report under civil or criminal procedure, and sometimes it's just a file note, either because you're in a without prejudice part of a process, or because you're not in a legal process at all, but it is we would like to understand what would happen if. And so often what happens when we are involved in litigation is we will start off with a file note. The file note will say, here are the main criteria, here are the main variables, here are the risks and variations of evaluation, here is the strength of various representations that we've made, of various bits of evidence that have been provided, here is how we would go about evaluation, here is the likely outcome of evaluation within a wide range. And then based on that, a litigation strategy is formed or is refined. And then we go back later and we do an expert witness report based on further information, based often on witness statement, relying on witness statements where we said, well, you may very well think this thing, but at the moment there's no evidence for it. So the evidence is collated, evidence is brought together from other sources. Sometimes it is, submitted as witness testimony. I'm in a process right now where, for whatever reason, the other side of the major piece of litigation declined to provide various pieces of evidence in the course of the disclosure process, in the course of supplying evidence, and then later they came back and provided witness statements from their employees for everything, and then stood up in court and said, well, witness evidence is the best form of evidence. You can cross-examine these people, you can take everything they have to say. Are you calling our employees liars, and so forth? It's an interesting tactic. I don't yet know how it's succeeded. I would say in general, notwithstanding the probity of any individual, I would much rather see a board minute from 2 years ago than an employee signed witness statement as to what they remember from a board meeting 2 years ago.
Great, thanks, Ben. I did have one final question for Jessie, but I think that I'm going to leave that, and we'll cover that off in the document that we circulate that I repeatedly referred to. I wouldn't mind getting into some of the Q&As from our audience. So some of these are really quite detailed questions, and I wonder if Ben and Jessie, that I'll pass those on to you later. So let's get into this. And we've had a few questions around how we determine the terminal value. Jessie?
I think I'll leave that to Ben. That's from the DCF.
Sure, yes. So
Right.
yes, the terminal value comes down to the DCF. So usually what you're doing is you're taking the same underlying assumptions from the rest of the DCF, the discount rate, the final year's forecast at the end of the DCF, and then you are doing a couple of things. First of all, you're applying a terminal growth rate. What's the expected growth of the business going forward? That essentially adjusts the discount rate to take into account the fact that the business is expected to continue to grow going forwards, if that is the case. In some situations, you might also apply a slightly different discount rate to a terminal value than you would to an ongoing forecast. If, for example, you're projecting the business is going to go through a period of growth and then stabilize, then you might push it up. If you're projecting the business has a great product for 4 or 5 years and is then going to have to go away and generate a new product which it will then sell in the future, you might more heavily discount later years just because the visibility is less apparent. I remember when I valued a football stadium some years ago, we built in the assumption that, well, this club might get relegated, they might qualify for the Champions League. So you'll push up the value at the discount rate to allow for greater risk in the short term, but in the longer term, you'd say, well, most likely this club will stay in the Premiership 75% of the time, will qualify for the Champions League once every 5 years or whatever, based on the sports side of things, and then you can sort of blend things together and get a lower and more reliable rate going forward. So I just want to pick up very quickly the first question that Jeffrey Leshak asked, which is about R&D for pharmacy, and it's different situation. It's the same sort of context. You are basically looking to take some sort of weighed or blended approach, which looks across a portfolio and says, well, we can't necessarily predict what any individual product is going to generate, but overall, we can tell from market research, we can tell from our past performance, that we can tell from the way that we've priced in risk and variability over a population, that over a portfolio of 20 or 30 products, this is the likely set of outcomes. The courts are loath to get too technical and sophisticated in valuations. I think they feel that sometimes experts are trying to bamboozle them. But something which I've seen a couple of times is, and if people know what it is, it's very valuable. If not, then probably look it up, because the next time you see a value, they may mention it, is a Monte Carlo simulation, which is a way of running a number of different outcomes at the time. I think that over time, as more and more people use these things, the courts and HMRC and so forth are slightly more comfortable with them, because they can see, well, this is a standard, this is a more standard expert thing. It's not just someone trying it on.
Thanks, Ben. I'm very conscious of the timing that we are at risk. Well, not even at risk. We are now running over very slightly. I can see that there is another 6 or 7 questions that are outstanding. So, guys, what I'm going to do is I'm going to pass these through to you straight after this session. For those that have outstanding questions, we will come back to you, and it'll either be Ben or Jessie. All that remains for me to say is thank you so much to you all for joining, and for you all to stay on for such a long amount of time. I believe that we might just be having some contact details pop up on the screen. That's great. Thanks, team in the background. Thank you very much to you all for joining. Thank you very much for our speakers. Have a great rest of the week, and we look forward to seeing you on another K3 Hub event soon. Thanks, everybody.